Hi, welcome back to the channel. In today's video, I'll be showing you how to analyze a balance sheet and explain to you what a balance sheet is. Now, just a disclaimer, this video is only for educational and informational purpose only. So let's get into it. So what is a balance sheet? Well, balance sheet is like a snapshot of a company's financial well-being at a specific point in time, specific time period. So in today's example, I'll be using a made-up company, and their balance sheet is going to be occurring during December 31st, 2025. Now, it's going to include things such as their assets, their liabilities, and their owner's equity. What are assets? Well, assets are anything the company may own, such as their land, building, equipments, their inventory, their cash on hands, and so on. Their liabilities may include things like their long-term and short-term debts. And shareholder equities includes things like their common stocks, treasury stocks, and retained earnings. So why is it called a balance sheet? Well, your assets should equal to your liabilities plus your owner's equity. So as you can see here in the example, my total assets, which is everything included in here, including property and equipment, current assets, and other assets, should equal to my liabilities plus my shareholders' equity. So how do you analyze a balance sheet? Well, first off, you have to assess how much cash they have on hand. And second off, you'll want to find out their liquidity or their ability to pay off their short-term debt. And to do this, you'll take their current assets and divide by their current liabilities. This will give you their current ratio. Now, a ratio above a 1.0 indicates that the company can pay off their immediate obligations. The next step is you want to calculate their leverage. Are they in too much debt? To do this, you have to find their debt to equity ratio. And the formula for it is you take their total liabilities and you divide it by their total equity. Now, a ratio below 2.0 is generally considered safe, but it does depend on what industries they're in. And you also want to check for high debt to assets ratios because it would indicate that they're using heavy leverage. All right, next up, you'll want to look at the company's retained earnings. Now, you notice there is a growth between this year's compared to last year's retained earnings. That means that the company is profitable and self-sustaining. And another thing you can do is evaluate their asset turnover. What that means is that their assets like their equipment and their properties is actually generating revenue for the company. That is very important to know. And that is how you analyze a balance sheet.